London, 1694, a new institution opens its doors and changes money forever. The Bank of England became the first public bank to regularly issue banknotes, paper as an alternative to coins. 3 centuries later, its mission is price stability, the quiet guardian of the pound. But inside these cautious institutions, a revolutionary idea is buzzing: money you cannot see. Central bank digital currencies, the future of cash rendered in pure code. A year ago, 80% of central banks were exploring digital money. Today, nearly 90%. Experiments doubled too, from 40% to 60%. The race is on. The idea of digital money isn't new. We swipe cards and tap apps every single day. So what would make a central bank's digital currency truly different? To understand that, follow the disruptor that scared them all: cryptocurrency. One coin towered above the rest: Bitcoin. February 2021, Tesla buys $1.5 billion in Bitcoin, and the price erupts. Its theoretical value soared past Visa and MasterCard, the giants of global payments. Unlike traditional money, Bitcoin answers to no central bank, only a network of machines. Blockchain, a digital ledger no single hand controls. Then a giant stepped in. Facebook announces its own currency, Libra, later reborn as Diem. That's when central bankers felt the ground shift beneath them. The question became brutal and simple: if we can't beat them, do we join them? Believers call Bitcoin digital gold, a hard cap of coins in an age of endless printing. As central banks printed trillions to fight the pandemic, scarcity became seductive. But there's a fear: independent crypto could loosen the central bank's grip on the system. Crypto carries no legal safeguards, no regulatory net. That spells instability. So the central banks ask the obvious question: why not build our own bank deposits, cash, private crypto? Each has useful traits. A CBDC aims to fuse them all. Your bank savings rely on a promise. A CBDC is backed by a power that cannot go bankrupt. If a commercial bank collapses, your savings can vanish. With a CBDC, they wouldn't. Trusted like cash, convenient like an app, powered by the same blockchain as crypto. And like cash, it could flow through commercial banks. No chaos, no central bank serving millions directly. Think of the humble banknote, today's closest cousin to digital currency, only on paper. The central bank sells notes to commercial banks. The banks feed them to ATMs and to you. Now imagine everyone with access, and the benefits start to stack. Faster payments, instant settlement, no more waiting in processing limbo. Cheaper too. In the US, retail payments cost up to 0.9% of GDP. And inclusion. Over 1.5 billion adults still live outside the financial system. Even in America, more than 6% of adults have no bank account at all. Digital currency could also fire stimulus checks straight into the hands that need them. So how close is this future? Look east to China. Since April 2020, the People's Bank of China has been testing its digital yuan. Tens of thousands of citizens, 2 billion yuan, over 4 million transactions and counting. For Beijing, it's also a reckoning with the giants, Alipay and WeChat Pay. Those apps belong to Alibaba and Tencent. The state wants that power back. The yuan would live in bank wallets, convenient enough to quietly displace them both. Picture a vault that can never be robbed, a promise that can never break. That is the dream central bankers are now chasing in code. Unlike your bank savings, which live or die on a bank's promise, a CBDC would be backed by the one institution that cannot go bankrupt. When a commercial bank collapses, part of your money can simply vanish. With central bank digital currency, the floor never falls out, as trusted as cash, as convenient as a payment app, yet riding the same blockchain rails that power crypto. And like cash, it could flow through the banks you already use, no central bank knocking on a million doors. Think of the humble banknote, the closest cousin to digital currency we have. Same trust, same authority, only made of paper. The central bank sells the notes. The commercial banks push them through ATMs. The chain is old, proven, and ready to go digital. Now imagine that chain carrying not paper, but instant programmable money, available to absolutely everyone. The first prize, speed. Payments that settle in an instant, with no waiting, no processing delays, no middleman friction. The second prize, cost. In America, moving retail payments around eats up to 0.9% of the entire economy. Digital money could slash those costs, pennies saved on billions of transactions, compounding into a fortune. And then there's the forgotten ones. Across the globe, over 1.5 billion adults are locked out of the financial system entirely. Even in the wealthy United States, more than 1 in 16 Americans has no bank account at all. Digital currency could throw them a lifeline, electronic payments in every pocket, no branch, no banker required. For governments, it's a powerful new tool. Stimulus checks delivered in seconds, straight to those who need them most. But here's the unsettling flip side. Money that can be aimed can also be controlled. Who decides where it flows? So how close is this future really? The race has already begun, and one nation is sprinting ahead of them all. China, the most advanced major economy in the digital money race, moving with the speed and scale only Beijing can muster. Since April 2020, the People's Bank of China has been quietly testing its digital yuan with 4 of the nation's biggest banks. Tens of thousands of consumers, 2 billion yuan spent, over 4 million transactions, and it's only a pilot. But this is about far more than convenience. For Beijing, the e-yuan is a weapon to reclaim control of its own financial empire. Because today, China's payments run through 2 private giants, Alipay and WeChat, in the hands of Alibaba and Tencent. These 2 apps swallowed China's transactions whole, and Beijing wants that power back. E-yuan won't bypass the banks, it'll live inside them with its own wallet quietly waiting at every account. And over time, convenience does the rest. People drift to the state wallet, and private giants quietly fade. But the real prize sits far beyond China's borders. This could be a strike at the crown jewel of American power, the dollar. Beijing has long seen the US dollar as America's secret strategic advantage, and it wants to chip away at it. The problem is brutal. Most of the world's real trade is still priced and invoiced in dollars, the greenback rules. China has struggled for years to push the Renminbi into the global system, but a digital currency? That could change the game. A technological edge might make the world see the Renminbi in a whole new light and slowly erode the dollar's reign. But China is not alone. Across the Atlantic, Europe is drawing up plans for a digital euro of its own, yet Europe moves with caution. Money laundering, terror financing, privacy, technology. Every landmine must be cleared first. Officials warn it could take 3, even 4 years before a digital euro ever sees the light of day. And that delay hides a deeper fear. Could digital money quietly sabotage a central bank's grip on the entire economy? For now, the bankers frame it as a simple payments question, but beneath that calm lies a far weightier date. Here's the radical thought. In theory, a central bank could push negative interest rates straight onto your digital cash. But remember, banknotes pay no interest. So if CBDC is their future, it should pay none either. Anything else is a new beast entirely. No central bank wants digital money to kill cash. The goal is to stand beside it, not bury it. But picture the nightmare scenario: a financial crash, panic, and savers fleeing their banks in a single silent click. If money rushes from bank accounts into central bank wallets, banks lose their funding, and the whole economy could choke. A bank run at the speed of a swipe. Instant, unstoppable, dangerous. This is the ghost that haunts every central banker. So as the world drifts cashless, the trillion-dollar question lingers. Will digital money ever earn the trust we placed in paper? China didn't wait for permission. By April 2020, the People's Bank of China was already running live tests of a digital currency the rest of the world had only theorized about. 4 state banks, tens of thousands of consumers, 2 billion yuan moving through more than 4 million transactions, a quiet revolution hiding in plain. This wasn't just about convenience. For Beijing, the e-yuan was a weapon to reclaim a financial system slipping into private hands. 2 giants ruled Chinese payments, AntPay and WeChat, owned by Alibaba, and together they controlled how 1 billion people spent money. Beijing looked at that empire of private payment power and decided it wanted it back. The e-yuan was the instrument of that reckoning. The design was clever. The e-yuan would stay woven into the commercial banks, yet still strike directly at the payment apps it aimed to replace. Every commercial bank would carry an e-yuan wallet. And over time, convenience does what force cannot, slowly displacing the rivals. But the ambition ran deeper than domestic control. There was a geopolitical prize glittering on the horizon, the US dollar's grip on global trade. Beijing views the dollar as America's strategic crown jewel. Most real-world trade is invoiced in greenbacks, and that hands Washington enormous power. Pushing the renminbi into the global system has always been a brutal uphill climb. But a digital currency? That could rewrite the rules entirely. A technological edge could make the world see the renminbi differently and begin slowly to chip away at the dollar's century of dominance. But this is not China's story alone. Across the Atlantic, the European Central Bank was sketching its own answer, a digital euro. Europe moved with caution. The digital euro wasn't a sprint, it was a years-long march through a minefield of hard problems. Anti-money laundering, terrorist financing, the privacy of millions, each one a wall that had to be cleared before a single digital euro could exist. The honest estimate from inside the ECB, 2, 3, maybe 4 years before launch. Revolutions in money do not happen overnight. And that delay raised a question that kept central bankers awake at night. Could a digital currency quietly sabotage monetary policy itself? For now, central banks framed it carefully, a payments tool, not a policy lever. The deeper debate was simply too early to have, but theory whispered something darker. If a central bank wished, it could push negative interest rates straight onto the holders of digital money, yet the purists pushed back. Think of digital currency as the future of the banknote, and banknotes have never paid a cent of interest. Make it pay interest, and you haven't built digital cash at all. You've built something else entirely and far more dangerous. Everything hinged on one unknown. How much would people actually use it? No central bank wanted to kill cash, only to walk beside it, because there was a nightmare scenario hiding inside the design. Picture a financial crash and the panic that follows. In a crisis, savers could flee their commercial banks and pour their money into currency backed directly by the central bank that can never fail. That's the danger. If digital currency swallowed bank deposits at scale, the banks would suddenly find themselves starved of funding. And when banks can't fund themselves, they can't lend. The financing of the entire economy could seize up from one quiet shift of savings. Truly terrifying part, it could all happen with a single click. A bank run at the speed of a smartphone. A run that once took days of lining up outside a bank could now ignite in seconds, racing across a nation before anyone could stop it. This is the tightrope every central bank now walks, chasing the future of money while terrified of the trapdoor beneath it. So they design with brakes built in, limits, caps, controls, anything to keep a digital dream from becoming a financial avalanche. As the world drifts toward a cashless future, one question towers over all the engineering and ambition. Could digital currency ever earn the trust we place in a banknote, that scrap of paper we believe in without a second thought? Quite possibly, but trust is not coded overnight. It could take months, it could take years, because here's the secret no one prints on a bill. The trust in private money rests entirely on trust in the currency behind it. And behind that currency stands a central bank armed with the tools to defend its value against every storm. As one central banker put it, we have to buy this trust, and the only way to keep it is to stay relevant in people's lives. Stay in the economy, stay useful, make sure people trust you, or watch a 3-century-old institution slide into irrelevance. From the Bank of England's first paper note in 1694 to a currency you can never hold, the entire meaning of money is being rewritten. Nearly 90% of the world's central banks are now exploring it. 60% are already experimenting. The wave is no longer coming, it's here. Faster payments, cheaper transactions, banking for the 1.5 billion locked out of the system. The promise is dazzling, and the risk is real. Whoever masters this technology may not just modernize money, they may quietly reshape who holds power over the entire global economy. It is the greatest monetary experiment in 300 years, and every nation now races to get it right before someone else gets it first. So the question lands squarely on you. In a world of money you cannot see, would you ever trust a currency you can never hold? China moved first. By spring 2020, the digital yuan was already live in pilot cities. Tens of thousands of consumers, over 4 million transactions, 2 billion yuan spent in a test run. This was never only about money, it was about taking back control from Alipay and WeChat Pay. Alibaba and Tencent had quietly become the gatekeepers of Chinese payments. Beijing wanted that power back. The e-yuan would ride inside commercial banks, but its real target was the apps it aimed to displace. And beyond China's borders lay a bigger ambition, a weapon against the mighty US dollar. Most global trade is invoiced in dollars. That dominance is America's quiet strategic advantage. China couldn't force the Renminbi into the system, but a digital currency might slip through a side door. Technological edge could make the world see the Renminbi differently and start chipping at the dollar's crown. But China wasn't alone. Europe was drawing up plans for a digital euro of its own. The European Central Bank moved with caution. Money laundering, terror financing, privacy, every risk had to be solved first. Their own estimate? 2, 3, maybe 4 years before launch. Revolution moves slowly inside a central bank. And a darker question, could a central bank push negative interest rates straight onto your digital cash? Think of it as the future of the banknote. And banknotes have never paid a cent of interest. No central bank wants this to kill cash. They want it to stand beside the bills in your wallet. But here lies the danger. After a crash, panic could empty the commercial banks in a single click. Savers fleeing to the safety of central bank money would starve banks of the funds that power the whole economy. A modern bank run executed not in lines outside a branch, but instantly from a phone. So the world drifts toward a cashless future. The question is whether digital money can ever earn our trust. Trust in money rests on one thing, the central bank standing behind it, guarding its value. That trust has to be earned, bought, defended every single day inside the real economy. From the Bank of England's first paper notes in 1694 to invisible money 3 centuries on, the story comes full circle. The future of money may be invisible, but the battle over who controls it is just beginning. So we leave you with one question. Would you ever trust your savings to money you can never hold?